Okay, good morning. We'll start with this 5.6 question. We have the annual returns I on a fund are independent and identically distributed with the mean of 6% and the standard deviation of 3%. Each year the distribution of 1 plus I is log normal with the parameter of mu and sigma square. Calculate the value of mu and sigma squares. First of all, they have given us the expected value and variance of I. Expected value is given as 6% and we'll say variance is given as I'll write it as 0.06 for now. It's just easier for calculation. So it would be 0.03 square. So first we have to calculate the mu and sigma square. Now 1 plus I is following log normal distribution. So I'll calculate the expected value of 1 plus I. We know if we add 1 here, will just be 1.06 and variance of 1 plus I will remain same, because in variance if we add or subtract a constant it does not change the variance. So it will just be 0.03 square. Variance will not change. So now we have the expected value in the variance of 1 plus I. We know 1 plus I is following log normal mu comma sigma square. So the expected value of log normal be e raised to mu plus half sigma square, that is 1.06, and variance of 1 plus I, that is log normal, e raised to 2 mu plus sigma square, e raised to sigma square minus 1, that is 0.03 square. Now this part is just square of this part. So I can substitute that. Let's say 1.06 square into e raised to sigma square minus 1 be 0.03 square. So if we rearrange sigma square is 0.0008, right? Now we can substitute that in our first equation, this equation. sigma square, so mu Any problem here? So let's go to the second part. Calculate the probability that the accumulation of a single investment of 1 will be greater than 110% of its expected value after 10 years. So what we want is probability of S10 to be greater than 1.1, 110% of the investment, right? This is what we want. Okay, no, my mistake. Actually, we want probability that S10 is greater than the expected 110% of the expected value. Okay. So 1.1 times the expected value after 10 years. So expected value of S10. Okay, this is how we will have to find. Okay, so first of all, S10 will follow log normal with the parameter as 10 mu comma 10 sigma square. This is the second part. Ten mu would just be 0.5787 and sigma square 0.008, right? Now expected value of S10, let's find the expected value of S10. Log normal distribution, so it will be e raised to mu, that is 0.5787 plus half of sigma square, that is 0.008. One 1.7909, right? Now our S10 should be 10% more than this. That is what we are trying to find. So we want probability that my S10 is greater than 1.1 times 1.7909. So we are trying to find probability S10 is greater than 1.9699, or I'll just say 1.97, right? We'll round it up to 1.97. So we'll convert it into standard normal distribution. Z greater than log of 1.97 minus mu is 0.5787 upon under root of 0.008. This will be converting it into from log normal to standard normal. If you are giving examination from IFOA, you can directly use RStudio to find any probabilities. Okay, so basically you can use RStudio as an alternative to your table book. So any probability that you can find in your table book, you can use RStudio to calculate it. Okay, so because I want probability of a standard normal greater than 1.11, and directly say here 1 minus p norm 1.11, and because we do not we have standard normal distribution, I don't need to give the parameters. It will automatically take it as 0 and 1. So the probability is 0.133499 or 0.1335. That's the probability. If you're giving the examination from India, that is the IAI, then you will have to use the table book. Okay, you cannot use the RStudio in your examination during your paper A examination. Okay, and for CM2 paper B examination is also of Excel. Okay, so even in that you cannot use RStudio. But if you are giving examination from IFOA, that is our UK institute, you can use RStudio Excel for your calculation during your paper A as well. Okay. So any problem here? So yesterday we started with chapter 6, right? That is our portfolio theory. We started with it. Okay. So I'll give the brief description. So we talked about portfolio theory. Okay, we said the mean variance portfolio theory or the modern portfolio theory consists of two main things that we want from any assets that we want. Okay, one would be the mean returns and second would be the variance of that returns, and these two values will be good enough for us to predict which assets will we choose in our portfolio. Okay, right? Now, other than these two, we'll be requiring the covariances between the portfolios. So, we talked about all the assumptions, right? And we talked about these things. We said we'll make a covariance matrix. Yesterday, I showed you what a covariance matrix would be, right? And we know that these C11, C22 and C33 just means that they are the variance of 1, 2 and 3, and these values that are across are same, these, this and this. So we just need the upper triangular matrix to know all the values of variance and covariances out of this covariance matrix. So we calculated how many would we require. Okay, so for 3 we said it would be 3C2. For 6 assets we'll have 6C2. So basically the number of covariances that we require, so the number of items that we require, so in an opportunity set of n assets, we said we need n expected returns, we need n variances, and we need n into n minus 1 by 2 covariances to accurately able to calculate which or how the portfolio should be created. Okay, now we are going to see how do we come up with that, okay, or how do we use it. So first of all, we'll talk about efficient portfolio. Now what's an efficient portfolio? Now see, let's say you have 10 assets from in which you can invest. Okay, so you will invest, let's say 1% in asset 1, 5% in asset 2, 7% in asset 3, and so on. You made a distribution that this is how I should be investing in these assets. Okay, you will get a certain returns out of it. Okay, average returns, we'll talk about how we'll calculate the average returns and stuff, but you will get a certain average returns. Let's say your investment portfolio where you decided certain, okay, let's not go for 10, let's go for 3. So let's say you have asset A, B and C. Okay, you invested, okay, your 25% here, 60% here and 50% here. This is how you have invested your money. Okay, instead of percentage, let us write it in fractions or decimals. Okay, this is how your investment is. They were giving you certain returns such that average returns that you are getting is, let's say, 12% per annum. This is what you are expecting returns from this portfolio. Now if I just increase or decrease certain ratios, these ratios if I change slightly and get a better return, okay, if I change these ratios and get a better return, then this portfolio will not be called as efficient. Okay. Now, although there are other factors that we have to think about, I'll talk about it in a minute. Okay, but you can imagine if I can get more returns, then this portfolio will not be efficient. Now we say more returns for a level of risk. Always remember, risk is also important. So we say that as investor is non-satiated, that means the investor is not satisfied with lower returns for the same level of risk, The investor will choose just say expected returns. So an investor is non-satiated. Okay. So an investor is non-satiated. That means for the same level of risk, the investor will choose the portfolio with the highest expected return. So on the same level of risk, you would choose the maximum returns that you can get. Okay. Because you are not going to be satisfied with the lower returns. So simply if I say fixed deposit provided by the same bank. Okay, so let's say SBI is providing you with fixed deposit, two fixed deposit, one is at 7% rate of interest, the other is at 9% rate of interest. For the same time period, let's say this is for 5 years and this is also for 5 years. You will clearly be choosing 9%, right? Why would you go for 7% when you can get 9%? I'm saying it's the same bank, so the level of risk is exactly same. You're investing for the same period of time, so why would you not go for the higher returns, right? So that is a non-satiated investor. Investor will always choose a higher returns for the same level of risk. You will not be satisfied with a lower return. So that is why SBI will offer you only one rate of interest, that is the highest possible rate of interest. It will not offer you the 7%. Right? The second point that we would like to say is as investor is risk averse. We talked about this yesterday as well. We said what's a risk averse investor? Investor does not like to take a lot of risk. So for the same expected returns, the investor will choose the portfolio with the lowest risk. Okay. So the investor will choose the portfolio with the lowest risk. Does that make sense? So if you have already decided a level of risk that I am going to take this much risk, then you should go for the highest expected returns at that level of risk. And if you have not chosen the risk, but you have chosen the expected returns, you are saying that I want 12% returns. Then at that level of returns, you should be choosing the lowest risk available. So you will create your portfolio in such a way that if you have chosen the level of risk, you will get the highest returns, and if you have chosen the level of return, you will choose the lowest risk. That is what an efficient portfolio is. Okay. So as I said, there are multiple options. You can have, if I say I have 10 stocks available in my opportunity set, I don't need to invest in all 10 of them, right? I will choose the best ones, right? And also in those best ones, I will be choosing how much to invest in which stocks, right? So that will change my portfolio, that will change my returns, as well as that will change my risk. Is that clear? So if we are talking about an efficient portfolio, we are saying an efficient portfolio is the portfolio that provides highest expected returns of a given level of risk, or lowest risk on the given expected returns. That would be the efficient portfolio, and there will only be one efficient portfolio for a set of opportunity set. Okay, of course there will be a lot of efficient portfolios for different level of risks. Okay, so if you're talking about different level of risk and different level of returns, you'll have a lot of efficient portfolios for each. But for each level of risk, if I fixed one of these, either I fix risk level, or if I fix returns level, whatever I am fixing, the other will give me the efficient portfolio. Does everybody understand what this is? So let's say this is my returns, this is the risk. Okay, so this is my, let's say, graph of expected returns versus risk. Okay. So what happens is, most likely I will get an efficient portfolio. See, it's going to be a straight line, but we'll understand that later why it is going to be a straight line. Okay, but for now I'll just draw a straight line. So this is efficient portfolio. This line is efficient portfolio. Now here we say that if you are taking this level of risk, this is the level of risk that you are willing to take, then This is the level of returns that you will get. If you take more risk, you will get more returns, right? Or if you fix, so you are going for the highest returns possible on that risk. So you are not going to be ready to take this much, or this much on the same level of risk. You are not going to take this returns, or this returns, or this returns. You will choose the highest. So we'll say this is the highest possible returns on this level of risk, and that is why we have chosen that point. Similarly, if I choose a return, okay, this is the, if I've fixed that this is the returns that I want, what happens is this is not available to us. Okay. These values are not, these are not possible. So this lower amount of risk is not possible if I want this much. And this I will not accept. Okay. I will not accept this much level of risk for the same returns. So this is the point where I would accept the level of risk and returns depending on whichever I wanted. Okay, whichever I fixed first. Okay. Now for a few terms, okay, we are going to use R as risk-free rate of returns. Okay, what it is used for, we'll talk about it later. Right now we'll just understand what we have. R, we'll say it is risk-free rate of returns. If I say RA, we'll say it is rate of returns for asset A. Okay, that's the rate of returns that we'll get from the asset A. Okay. Then RP, we'll say rate of returns from the portfolio. Okay. Many times, just for explanation purposes, I will assume that a portfolio is nothing but one single stock. Okay. So for understanding, we can treat portfolio as one single stock also. Okay. But portfolio is a collection of all stocks. So RP is nothing but the average returns that we are going to get from all the different assets that we are buying or we are keeping in our portfolio. Then we'll say EA is expected rate of returns for asset A. So EP is nothing but expected rate of returns for portfolio. Then we'll use sigma square A variance of rate of returns for A. We may also write this as VA, okay, variance. And this we can also write it as VP. Okay, it depends on what we are trying to explain. Sometimes we use sigma, sometimes we use V. Okay, so these are also the terms that we can use. And then we have CAB, covariance. So CAB we are going to use for the covariance of rate of returns for asset A and B. Does that make sense? All of these terminologies? Okay, we'll write one more, XA. Okay, XA is going to be proportion of investment in asset A. So if let's say I have 5,000 rupees for investment and I invest 2,000 rupees in asset A. Okay, so the proportion will be 2,000 by 5,000, that is 40% or 0.4, right? So proportion we are going to take as, you might say, probability or ratio of 1, right? So we'll assume we have invested 1 rupees and how much I will invest in A would be XA. Any problem here? So for a portfolio of n assets, what are the available data that we have? Okay, so the available data that we'll have is, we'll have n rate of returns, okay, we'll say r1 to rn, all of these values are available to us. Then n variance, let's say for now we are talking about v1 to vn, that it can also be written as, that is same as it is c11 to cnn, right? We can write it like that also, right? You can write here that vi or vk, let's write k, vk is same as ckk. And we have n into n minus 1 upon 2 covariances. That would be C12, C23, and so on, C1n. Okay, all the possible combinations. So I'll just write n minus 1, all the possible combinations we know. These are the available data for us. Now we are going to decide how much money are we going to invest in the first asset, how much are we going to invest in the second asset, how much we are going to invest in the third asset. Okay, so these proportions are decided by the investor. Okay, so I'll say RP, returns on the portfolio. Say returns on the portfolio RP would be nothing but a combination of all the returns from each of these investments, right? So that is nothing but x1 r1 plus x2 r2 and so on, xn rn. Just returns on the this is just an average of all returns. Okay, because I invested x1 amount in r1, x2 amount in r2, and so on, this just becomes a weighted average. Just becomes a weighted average, right? I can write this as RP is nothing but summation k going from 1 to n xk rk. Any problem here? See, basics are very important for us to understand. Okay, So at any point, if you feel like there is something that I did not understand, you should always ask. You should never hesitate to ask. Okay. Now taking expectation, we can say EP, expected returns on this portfolio. Now see, these R values are not constants. Okay, these R values are variable because the returns that I'm going to get in stock market is not going to stay same, right? It's going to keep on changing with time. That is why we studied the stochastic model in the previous chapter, right? So they are going to keep on changing. So this RP is also a random variable. So if I want the expected value, it's just going to be summation k going from 1 to n xk, because this is the amount, this is fixed amount. How much did we invest into EA? It's going to be nothing but the EK. Okay, EK. Okay. Right? It's just going to be the weighted average of the expected values. Now for the risk factor, that's our variance. You should remember that variance of A plus B. Okay, variance of A plus B, we say it is, I'll write it, variance of A plus B would be variance of A plus variance of B plus 2 times covariance of A comma B. This is the formula. Variance of A plus B would give me variance of A plus variance of B plus 2 times covariance of AB. So if I take variance of these returns, if I take variance, what do I get? I get variance of A plus variance of B and 2 times covariance of AB. I can also write this as covariance of AA plus covariance of BB, covariance of I'll write it as CAA plus CBB plus 2 times, or instead of writing it 2 times, I can say it is CAB plus CBA, because covariance of AB and covariance of BA are exactly the same, right? So these are all 4 combination AA, BB, AB and BA. All 4 combinations of this covariance. So we are going to use the same. We are going to say that the variance V for portfolio, so I'll just write it as VP, will be equal to the variance of returns on the portfolio RP. That would be, I'll add both of these value, I'll say summation K going from 1 to N and summation J going from 1 to N. Okay, so I've used J and K. I think I and J would also work because we are not using I as a rate of interest now. So you can use I and J everywhere. I've used K and J, okay, for the iterative variable. Okay. So first of all, I will have here C, J, K, right? That's the covariance. I'm saying all possible combinations of these. But that would just be the variances and the covariances of R1, R2, R3 and Rn. All the possible combinations. But I also need the amount of investment that I have done. This is x1, x2, xn, so on. Right? So if I had let's say variance of 5a plus, okay, I will write variance of 5a plus 3b. If I had some constants multiplied, what would have happened? You would have said 5 square variance of a plus 3 square variance of b plus 2 times 5 times 3 covariance of AB. This is how we would have written. So here in this CAN terms, I would have written it as 5 into 5 CAA plus 3 into 3 CBB and plus 5 into 3 CAB plus 3 into 5 CBA. Right? So what I have written is first the coefficient of the first letter, then the coefficient of the second letter. Similarly here, first the coefficient of the first letter, then the coefficient of the second letter. First the coefficient of the first letter, then the coefficient of the second letter. So I'm just multiplying with the coefficients. So even here, I'll say I'll have x, j, x, k. Okay, x, j, x, k. Proportion for the jth asset and proportion for the kth asset. Any problem? Now see, the assets that we were talking about, we'll call them as securities. Okay, so from this point on time, we'll use the word securities for our assets. Okay. Now that's a general term for all the derivatives. I hope everybody knows what a derivative is. A derivative is just a entity that derives its value from an asset. Okay, so that would be called as a derivative. There are a lot of derivatives. There are a lot of different types of derivatives, but we'll not be going into what are derivatives and stuff. Okay, we'll call them as securities. We'll not even call them as derivatives, but simply wherever you are investing your money, we'll call that as a security. So derivative is also a part of security. So first I'll just explain a derivative. So see, the stock that you have, so if you buy a share or a stock of a company, that share of or a stock is deriving its value from the ownership of the company. So basically it is part of that profit or the revenue of the company, correct? It's deriving its value from the performance of the company. So it's deriving from some assets, some tangible values, right? Similarly, if I buy a property, okay, so the piece of paper, the sale deed and everything, that becomes the derivative. It is deriving its value from the uh, property, but of course we don't consider sale deed as a, what do we say, a derivative. But if I lease that property to somebody else, that can be again released. Okay, so let's say government gives me a property on 100-year lease, okay, to do some kind of business. What I would do is, let's say I built a house there on which I am giving people house on rent. Okay, I built a property on which there are multiple flats. I am giving them on again lease or rent, right? So that rent agreement will derive its value from the property, correct? So what I am doing is I am also renting the property from the government, but then I am re-renting. So that next agreement that I am going to make, the value, where does the value come from? The value comes from the property. There is an underlying asset behind it. So those are derivatives. Okay, so securities, derivatives, these are blanket terms that usually take into account all the assets. Now there are some non-tangible assets as well. Okay, so assets that does not have a physical form would be called as a non-tangible assets. Simple example I'll give is the brand of a company. Okay, brand of a company also has value. Okay, today if I want to start a let's say cold drink business, okay, I'll name it XYZ cold drink. Okay, it does not have much value. Okay, people might not know my name or the brand and will be reluctant to try it. But if I go and buy Coca-Cola and then sell my cold drink in the name of Coca-Cola, then everybody will try it because everybody knows what Coca-Cola is. So that brand is giving me some leverage here, right? Brand Coca-Cola is giving me some leverage here. So when I'm buying Coca-Cola's name, I'll have to pay them a lot of money because that name is going to give me a lot of marketing power or whatever you want to call it. That's the brand power, right? So, but there is no physical, asset behind that name. So that becomes a non-tangible asset. Okay. So we are not going to talk about any non-tangible assets or non-tangible, uh, things here. Okay, we are mostly going to talk about, no, not even mostly, we are definitely going to only talk about the tangible assets. Okay, that comes into security. So security just means wherever you are investing your money in. So it may be stocks, it may be property, it may be fixed deposit, it may be gold, it may be silver, whatever you want to buy. That would be called as commodities. You can buy commodities as well. Okay. So wherever you are investing your money would be called as securities. So we'll use the word securities many times. So let's say if we are talking about two securities. So if we have two securities, let's say SA and SB. Okay. So same thing, the amount that I have invested in SA would be XA, amount I have invested in SB would be XB. So remember, first of all, XA plus XB will be equal to 1. You can write that also. Let's write that as well here. Okay, we'll say summation XK's, K going from 1 to N, will be equal to 1. This is an important identity as well. Okay. So the amount that I am investing, I have total of 1 rupee, or you can say this is nothing but the proportion, right? However you want to see, you can see total of 1 rupee, or you can say these are just proportions of our investment. Okay. And then expected value of the portfolio, or the expected returns that I'm going to get from the portfolio, would just be EA into XA into EA plus XB into EB. Very straightforward. And then the variance of the portfolio would be XA square VA plus XB square VB plus XA 2 times say XB CAB. Is this clear? Is this straightforward? Any doubts here? Okay, so for example, we have taken 2 securities, okay, or 2 assets. Now let's just take an example. This is page number 9. So this is chapter 6, page 9, question. So you're saying consider a portfolio consisting of equal holdings of 2 securities, SX and SY, where the returns on SX is equally likely to be 5% or 10% per annum. Okay. So it is equally likely to be 5% or 10% per annum. Okay. The returns on SY is equally likely to be 10% or 20% per annum. So if I say returns, okay, for returns many times we'll just write capital R. Capital R represents the random variable, that is random variable for the return of where I use small r every time, right? RA and RB. We can use capital R's as well. Okay, no problem there. Okay. So because it's the random variable, we prefer capital letters for random variable, not just R. Okay, we prefer capital letters for random variable. So the random variable returns for the security X, the possible values are 5% and 10%. And the probability, they are equally likely, so 0.5, 0.5. Then same thing with return on investment for Y. Okay. So here quickly let's calculate the expected value and the variance for both of these. So EX, we'll keep it in percentages because we want finally answer in percentages. So of course going to be 7.5%. For variance you can directly calculate if you want. Okay, you can use any formulas, any structure of formulas you want. Okay, I would write expected value of Rx square and just square it this equation. Variance will be expected value of x square minus expected value of x whole square. So remember our expected value was in percentage, so our variance will be in percentage square, but we write it as percent. It's percentage square. Okay, we write it as percent. Same thing we'll have to do with y. So it's going to be in middle. Okay, so we know it's going to be 15. Expected value of ry square we just use the previous equation, square them. So 25%. So this is the expected value and the variance for each of these securities. Any problem here? Second part says calculate the mean and the variance of the return on the portfolio as a whole, given that the correlation coefficient of the two securities are this. So we know what a correlation coefficient is. correlation coefficient, we usually write it as R. Okay. You can write it as CORR if you want to, whatever. Okay, correlation coefficient, that is a Pearson's correlation coefficient. We'll say it is nothing but the covariance between A and B upon standard deviation of A, standard deviation of B. This is what our correlation is going to be. So using correlation, we can easily find the covariance. Covariance of AB is just going to be R into standard deviation of A, standard deviation of B. Right? We can find covariance very easily using the correlation coefficients. So here they have given us correlation coefficients. Now instead of first solving it, let's just discuss. I want you all to answer here. Okay. What does correlation coefficient of 1 mean? What does that mean? Correlation coefficient of 1. So I would like you all to answer. What does correlation coefficient of 1 actually mean? If you don't remember, let me know. I don't want you all to be, what should I say? I don't want you all to be confused because you don't remember what we have studied before. Okay, so at any point, first of all, you should not forget anything. These correlation coefficient and stuff you have studied in CS1. So you should not be forgetting anything. But if you don't, never hesitate. Just ask me. Okay. So when we say correlation coefficient is 1, that means we have perfect positive correlation. Positive correlation means both are moving in the same direction. As X increases, Y will also increase. Right? 0 means zero correlation, means there is no correlation. There is no relationship between X and Y. -1 would be perfect negative correlation. That means as X increases, Y is decreasing by exactly the same ratios. Okay, 1:1 ratios and something like that. Okay, so same ratios throughout. 0.7 would just means they have good positive correlation between them. Okay, it's not perfect, but it is good. Right. So this is how we are going to study the assets. Either they will be perfectly correlated or maybe a good correlation between them. That means if the stock price of one increases, the stock price of second also increases. Okay. Zero correlation, they are not at all correlated. Like if I say toothpaste company like Colgate and Tata Steel, they don't have anything to relate to. Okay. So they don't have correlation between them. So their stocks are not related to each other. -1, they are perfectly negative. That means if one, the stock value of one increases, the other most likely decreases. It depends on a lot of factors. It's not always 1-to-1. So perfect correlations are very rare. This is just for our example. Okay. Because the relationship between the stock values is a very complicated subject. Okay. So first we are saying R is 1. Okay. So R is 1. So I can say covariance, that is C XY in this case. Okay. C XY is going to be R. Standard deviation. Okay. You can write standard deviation. You can write root of X. You can write sigma. This is another reason I prefer writing sigmas. It's just easier to write rather than writing roots and stuff. Okay, you can write sigmas, no problem there. So accordingly, root of 6.25 into 25, 12.5. Covariance will also have percentage square, same as variance. Okay, always remember that. Okay, so now we have the covariance. One more thing that I would like to know is what are our XAs and XBs. So they are saying calculate the mean and the variance of the return on the portfolio as a whole, given that the correlation coefficient of the two securities. Okay, how much did we invest? Have the return. Okay, equal holdings of two securities. So here you can see they are saying equal holdings of two securities. That tells us that XA is equals to XB, that is 0.5. Okay, equal holdings. EP, expected value of the portfolio. See, if we are just worried about one portfolio, you can just write E as well. That is also okay. E and V, we'll assume that is for portfolio. Okay. So I'll have 0.5 into E of X, 0.5 into E of Y, so the returns that we are going to get from this portfolio averagely. So this is an average return, expected returns. See, many times in different courses, you will find that the average and expected terms are different. But here, average and expected terms are same. Okay. So the expected returns, average returns, I'll be using these terms interchangeably. Okay. So the expected returns or the average returns that I can earn from this portfolio is 11.25% per annum. What about the variance? V. It's XA square, so 0.5 square. Vx is this, plus 0.5 square into Vy plus 2 times XA XB, and then the covariance. Any problem here? Everybody following properly? So in the first case, we are getting that the expected returns is going to be 11.25% and the variance is going to be 14.0625 percentage percent. Did they talk about variance or standard deviation? No, they said variance. Okay, so we have to calculate the variance. In the second case, B, when R is 0, Cxy will also be 0. Cxy will also be 0. So clearly, first of all, expected returns is not at all changed by the covariance, right? Clearly there is no covariance, there is no R, there is no, okay. One thing we should okay, we should not use R for this correlation. Please just correct it, because R we are going to use for risk rate of returns, risk free rate of return. We wrote that at the beginning. Just write this as CORR. Okay, CORR, or just COR will also work, no problem. COR, correlation. Okay, wherever we have written R for correlation, just correct that to COR, correlation. This is also COR, because we don't want us to get confused between R's, right? R we are going to use for risk free rate of returns. We are going to use that throughout our course, throughout CM2. So that is why let's leave that there. And for correlation, we'll use COR. So if correlation is 0, then the covariance will also be 0. So expected returns will not change. Expected returns will still be 11.25%. But it will change the variance. How much change? This factor will just become 0. So variance 0.5 square into in C we said COR is -1, correlation is -1, then the CXY, the covariance between X and Y, is just going to be the same, just negative, right? It's just going to be negative because COR is negative. So minus 12.5%. So again, expected returns is going to be same, 11.25%. The variance and now minus of 2 into 0.5 into 0.5. So I'll use the previous equation, so it's the one, and edit minus sign. So you can do the D part yourself, right? D part I'll leave it up to you. Now these three parts, with this simple example, the whole strategy of investment has been taught. Okay. Just with this example, simple example, A, B and C. Okay. Now, what is this? What am I talking about? Now we know that we should not invest in just one single asset, one single stock. We should not invest. Okay. See, if you invest all your money in just one single asset, one single stock, what happens if that company does not do well? Then immediately you lose all your money. That's the risk that you're taking, a lot of risk. And that is why we are going to select multiple assets. That is called as diversification. Okay. Now, how should we choose those assets? How should we diversify our wealth? Okay, our investment. So the first thing is, you can choose, we are saying here two stocks. So let's say two stocks. So we are talking about two stocks. Now those two stocks are very much related to each other. That means as one increases, the other increases too. They are similar type of stocks. They follow the similar factors. Okay, and their growth will be exactly 1-to-1. If we choose such stocks, let's say I'm talking about Tata Motors and Maruti Suzuki. Both are making car companies, similar type of cars. Their market share is very similar. Their audience is very similar. See, I'm not talking about Mercedes and Tata. I'm not talking about Tesla and Tata. Okay, those are totally two different types of companies. Their target audience is different, right? They make the Mercedes and Tesla. They make very high-end cars. Tata does not make that high-end cars because the target audience cannot afford that high-end cars. The build quality, the features that they give will be a lot different. Correct. But Maruti Suzuki and Tata are in very much in sync. Their target audience is same. Their products are very similar. They are priced very similarly. They are in almost same competition. They are targeting exactly the same people. Okay. And that is why they are alternatives of each other. So if I choose such two companies, what would happen is it will give me certain amount of risk. Okay. Now in all of these three examples, A, B and C, you will see the highest amount of risk taken is in A. So if I choose similar types of companies, then I will take the highest amount of risk. Okay. I will be taking the highest amount of risk. So diversifying in similar companies is not a very good idea. It's almost the same as investing in just one single company. Okay. It's more or less investing in the same company. So it's not a very good idea. So how should we diversify? Okay. We should diversify in companies that are not related to each other. Their covariances are zero. They are not related to each other. Okay. So I will invest in Tata Motors and I will invest in let's say Colgate. So they are not at all related to each other. Okay, the underlying factors that will affect their audience is also different. Okay, like if I say petrol prices increases, of course car sales will go down, and the cost of making for a car is much higher. So sales will go down as well as their cost of making will go up. Automatically the share prices, the profit will decrease, so automatically the share prices will also decrease. But do you think the same thing will happen to Colgate? Of course not. It's a toothpaste company. The amount of crude oil and petroleum used is most likely in the transport. There is no use of petroleum in making or after making the product, right? So they are not going to be affected by petrol prices by that much. They'll be affected, but very little, right? So there will be a lot of factors you can see, and most likely Tata Motors and the, what do we say, the Colgate company will not be related to each other. We'll say they are independent of each other. Okay, so I'll choose those two companies for diversifying. Okay, so that is what diversification means. You are selecting different companies from different groups, so that if one is affected by a certain factor, the others will not be affected, and your returns will not be affected by a very large amount. So you have diversified. So you have basically taken less risk. That is called as diversification. Okay, you are taking less risk, overall risk. Okay, but that is also not the best strategy. You know the best strategy? The best strategy would be where the correlation is negative. This is called as hedging. Okay, this is called as hedging. Okay, that's the best strategy of investment. Now what is hedging? Now let's say we are playing a game. Okay, I am tossing a coin. We'll get either heads or tails. We know that approximate probability for getting heads and tail is 0.5 and 0.5. Now if I say you have to bet your money, and I'll give you double of it. Okay, I'll give you double the money. So one strategy would be you will bet either heads or tails. It will not matter, because there is a 50% chance you will win, 50% chance you will lose, right? It's very difficult for us to know which one we'll get next. But one of the strategy would be you will invest 1 rupee here and invest 1 rupee here. Okay. So you'll say I'm investing 1 rupee for heads, I'm investing 1 rupee for tails. So now you are not going to lose at all, right? So what happens is, if I get heads, you get 2 rupees. If I get tails, you get 2 rupees. You invested 2 rupees and you got 2 rupees in returns 100% of the time. So clearly you are not losing money. So what you have done is you have invested in all possible outcomes. That is called as hedging. Now of course in this case, especially in gambling, hedging will not give you profit. Rather, hedging will still get you losses, because most likely what I'll do is I will say the fees of this game is 1 rupee, but if you get it right, I will give you 1.75 rupees. I will give you 1.75 rupees. So if you just invest in heads and win, you will win 1.75. Or if you just invest in tails and win, you are going to win 1.75. But you invest in both heads and tails, you have invested 2 rupees and you are going to win only 1.75. So clearly you are at a loss. This is how gambling works. Okay, they make sure that you cannot bet in all possible items and then make out profit or even break even. Okay, so they make sure that they keep the rewards slightly less than the total expenditure or total income that they will have. Of course they have to, correct? So that 0.25 would be my income. That makes sense. Okay, so but when it comes to stock market, you can still earn slight amount even if you have hedged all possibilities. Okay, so like here, when my correlation is negative, okay, that means if a stock price increases of one company, the stock price of the second company will decrease. Okay, that is negative correlation. Here they have taken perfect negative correlation. Let's not talk about that. This is just for example, for easy for us to solve. That's the main reason. Okay, so in this case, what is happening is, I'll give you a simple example, that if I'm talking about Tata Steel and I'm talking about HP Petroleum. So if petrol prices increases, what would happen is HP Petroleum, see, petrol is one of the essential commodities, so people will not just stop using petrol just because the prices has increased. So what happens is the demand of petrol most likely will not be affected. If the demand has not affected, the price has still increased, then automatically your profits will increase. So HP Petroleum will have more profits because it's just percentage of the price, correct? Then but if I'm talking about Tata Steel, I think we talked about this before also, that their raw material, that is iron ore and coal, and also their product, that is steel, are very heavy and they are very much transport dependent. Okay, so your factory might be in Madhya Pradesh and you have to bring it to Mumbai, so it's going to be a long distance. So transportation is key, and of course because it's very heavy, it will consume a lot of diesel. So it's very much transport dependent. So if the petroleum prices goes up, their profit margin will go down, correct? Because just because see, petrol prices fluctuate every 15 days, but that does not mean that the Tata Steel will keep on changing their prices every 15 days, right? That's not possible. So what would happen is the profit will go down, right? So their profit margin will go down if petrol prices increases. So HP Petroleum stock value will increase, Tata Steel stock value will decrease. So if I had bought, let's assume 1:1 ratio, that means I'm saying petrol prices if increase by 1 rupee, okay, petrol prices if it increase by 1 rupee, I'll say Tata Steel stocks will decrease exactly by 1 rupee and HP Petroleum will increase exactly by 1 rupee. I'm just assuming, okay, it can be any ratios, but that just means if I buy one stock, one share of Tata Steel and one share of HP Petroleum, what happens is, now if petrol prices increases, I will have no effect on my portfolio. The same thing you can see if petrol price decreases. If petrol price decreases, Tata will have profit, but HP Petroleum will have losses. So even in both cases, whether petrol price increases or whether petrol price decreases, I will have no effect on my portfolio. And that's a very good thing, because predicting petrol prices would be a very difficult task. So if I can diversify my portfolio in such a way that it does not affect whether the petrol prices increases or whether the petrol prices decreases, then I will be very happy, because petrol prices are very volatile, right? So that is what hedging means. We make sure that our the risk is decreased, reduced, or almost negated by investing in stocks that are what do we say, negatively, or what do we say, proportional, inversely proportional, inversely proportional to each other. Okay, so that is hedging. Okay, that is this example here, and we can say that hedging gives us the least amount of variance in all the three strategies. Okay, so we talked about these three strategies, right? So hedging gives us the least variance. Okay, but hedging is the most difficult to maintain. Okay, because what happens is, first of all, at the beginning, if I have exactly this ratio, if petrol price increases by 1 rupee, Tata Steel will decrease by 1 rupee and HP Petroleum will increase by 1 rupee. If I have exactly the same ratio, it will not remain same throughout the time period. Or even if this does not guarantee that if petrol prices increases by 5 rupee, then Tata Steel will decrease by 5 rupee and HP Petroleum will increase by 5 rupee. That is not guaranteed. It may affect differently at a different ratio, right? And as time progresses, these will keep on changing. Okay. So maintaining hedging is the most difficult thing, but that is what investment managers do. They try to figure out how can I hedge my bets to have the minimum risk for the same level of returns. You can see you had the same level of returns in all three, and you will choose the strategy that will give you the minimum risk for the same level of returns. That is what your efficient portfolio says. That makes sense? Right? So that is our strategy. Okay. So the whole course we are going to try to learn how do we hedge, how do we diversify, what are the different strategies, what are the different types of investments. Okay, it's a very interesting course. Throughout you are going to learn from the basics. This is very basics. We don't know how these risks are calculated. We have just calculated the variances. We'll study what are the different types of risks. Okay. Correlations. How do we come up with this correlation? These kind of stuff we have not studied. Okay. So there are a lot of things that we have to understand before we can do this practically. But this simple example lets us understand how well or how the strategies are designed, right? So that's it for today. This was the last demo lecture. Okay, so next time we'll meet next Saturday after you have registered for the lectures. Okay, any problems, any issues for the last time right now, today's lecture? Any questions? Chalo, let's end the class then. Okay.